Uber stock is down 30% since its all-time highs and down around 3% for the full year of 2024. And this is despite this company showing great progress in their revenues and especially their profitability and free cash flow generation. Now, one of the main reasons for this drop in price is that Waymo is expanding to different cities around the US, and it even has plans for its international expansion, starting with Japan. This, of course, has raised concerns of whether Uber will be able to compete against Waymo and a possible Tesla entering its space. But the second reason is that they wanted to take over a leading company in Taiwan for almost $1 billion, but it was actually blocked due to competition concerns. But this does not make any sense to me, because the stock price has dropped around 3% for the full year of 2024. However, if we compare the financials from one point to the other, it had revenues of 9 billion with a net income of 0.2 billion. Whereas in the following year, where we are right now, Uber has total revenues of 11 billion with a net income of $2.6 billion. So while their revenue has increased over 20% over the time that the share price has decreased 3%, the net income of the company has increased by over 1,000%, as it has more than 10 times what it used to be a year ago. Now, it does make sense that the majority of this increase has actually just been a decline in the valuation of the company, as the price to earnings ratio went from a 93 times earnings to a 37 times earnings, and this was at the time of the earnings release. Right now, Uber is trading at a PE ratio of around 30 times, and when we look at the forward PE ratio, it's around 25 times, which looks very cheap when we assess the growth conditions that this company actually has. Throughout this analysis, we'll be taking a look at Uber's investment presentation. And as over here we can see, this was how they closed the 2023 year with around 150 million monthly active consumers in their platform and over $140 billion in gross bookings. And now to counter what anyone is actually saying that Waymo or Tesla could actually enter the space and take away a lot of market from Uber, we have to also consider that Uber is growing in a lot of different aspects. It has its delivery platform, which is extremely profitable, its freight revenue source, which is growing consistently, but still doesn't make a significant portion of the revenue. One thing that people aren't actually recognizing is that Waymo may not actually be a direct competitor to Uber, because in a lot of articles, it is seen that they actually have a partnership and you can actually book a lot of Waymo's services using the Uber platform. And this is shown right here. They're actually partnering with a lot of these autonomous vehicle companies in order to include them into their platform, because Uber is not a provider of mobility services. It is a platform that connects people who are providing mobility services and people who are desiring those mobility services. So Waymo or Motional or Aurora or any other provider of autonomous vehicles can actually offer their services inside Uber's app and get paid for those services that are being offered. Just to give you an example, in most cases, Uber works like a taxi service where you get into the app, you book an Uber, and a driver comes in, picks you up, and then leaves you at your destination. The driver gets paid around 70% of the fee that you're actually paying for the trip. The other 30% goes to Uber. Well, when you're integrating these sort of companies like Waymo, Motional, or Aurora, what you're actually doing is just replacing the driver. So you're taking that driver who was earning around 70% of the commission for the journey, and you're replacing him with Waymo. So Waymo is not going to be a direct competitor in most cases. It's just going to replace the driver, which will honestly leave Uber indifferent because they're just the app that connects the drivers to the riders. Now, just in order to go over a different point of view, we'll go over this article by Kavanagh Research where he talks about why he's actually buying Uber while others are selling the stock. Of course, he starts off the same way that we did, where he says that there's been a 30% drop in the stock and that it's actually being outperformed by the S&P 500 in this year. He then does a quick glance over the financials to show that everything is okay, that Uber over the past 12 months has generated over $42 billion in revenues, which is a big increase over the past years at around a 14% increase in these revenues. But the greatest thing about Uber right now is that its free cash flow is growing extremely quickly and has jumped to $4 billion, whereas last year it was at $1 billion and in previous years it was actually negative. Just look at the growth trajectory that this company has been having, which in just 4 quarters has gone from negative $262 million to positive $700 million. And this still has a lot of room to run. But the best thing about this investor presentation is that they actually show that they're making an effort to improve their margins. How? Well, reducing all the different costs and personnel inside their organization to the point where they're actually stating on a slide that in order to improve their margins in the future, they're going to be firing people from the support functions, they're going to be reducing their cost of payments, and they're actually going to be streamlining as well research and development and general and administrative departments in order to improve these margins. And they've shown how they have been doing it so far and how they're going to keep attacking these fronts in order to improve their margins, both their net margin and their free cash flow margin. And this slide, I think it's the best one in the whole presentation, where we're going to focus on the free cash flow and the free cash flow conversion. As you can see, from 2018 to 2020, they were generating negative cash flow of around 11 billion, and this is the Uber that most people know, the one that was a cash burning machine. But in 2021 and 2023, they actually changed their mentality and they started to streamline their operations. This was a similar case with Salesforce. They saw that their growth was slowing down and they said, hey, now we have to activate different sort of initiatives in order to keep our momentum, but instead of with top line growth, now we have to grow our bottom line. This way, they generated around $3 billion in free cash flow, which is around a 60% of adjusted EBITDA. But the beautiful part about this is that their plans for 2024 all the way up to 2026 is to keep their focus on growing their free cash flow. And this is beautiful because, well, you know, we're the cash flow compounders, so this is why I got so excited reading this. And this is exactly how they plan to do this. But the best part about this is that they also have a plan on how to allocate this once they have generated it, as they first of all want to prioritize growth by either conducting acquisitions and also conducting organic investments. Then they want to optimize their liquidity, grow their cash and improve their balance sheet. But the long-term return, they want to focus on those share buybacks, which is the one thing that I had been missing from this company. And on the right side, you can see that their first share repurchase authorization was for $7 billion. And additionally, one thing that they're doing is cutting down on that big stock-based compensation that they used to have. Don't get me wrong, it's still very large, but at least it's not growing, and they're starting to attack it. And just for those doubters which were not convinced by the Waymo theory, even if Waymo decided to just go as a standalone business and offer all their services from their own app, there was a study comparing all the different mobility providers in San Francisco, which is where Waymo mainly operates, and they found out that not only Waymo is the most expensive ride, but it's also the one that takes the longest, which when you're waiting for a cab, you can actually state as the worst quality service. The great thing about Uber is that it was the one with the best quality service, meaning shorter waiting times. I know Waymo can improve this gap in the future. However, there is still a lot of time for Uber to actually be able to respond to Waymo and develop answers of their own. And now, despite this article not containing what I usually like most, which are the different risks, he does argue that Uber, and I quote, should be priced at a multiple that aligns with the company's projected double-digit gross margin expansion and 20% plus free cash flow growth for the next 3 years. Since we are expected an $8 billion in free cash flow for 2025, should give the value for this company of $160 to $200 billion in market cap versus the current market cap, which is around $130 billion. This is not a huge increase, but it does present a compelling argument that Uber is actually undervalued. Now, I do have to say that I was a lot more convinced about purchasing Uber before I actually started doing the research, because I have seen that this net income and that this free cash flow contain one-off items that would make this video just too long in order to explain. However, I will still be doing a deep dive on this company, and if at the end of the day I decide to make a position on this stock, you know that first of all I would publish it on my Patreon and possibly a video describing why I decided to buy the stock. So thank you for watching. As always, this has been the Cashflow Compounder, and we'll see you in the next one.